Okay, good afternoon, everyone. Thank you very much for joining me. It's just coming up to the cusp of 2 p.m. Eastern Time on Tuesday, October the 12th. And today's webinar is about cryptocurrencies and the three things that we believe, our team believes, that you really should know before you start trading cryptocurrencies. Now, before we get into the meat of the presentation, it's a quick risk disclaimer, something you've seen probably 100 times before. Essentially, it's letting you know that today's webinar is for educational purposes only, and nothing that I say should be deemed as investment advice. Okay, with that out of the way, tell you a little bit about who I am. My name is Huzefa Hamid. I am one of the senior analysts with dailyforex.com. I've been writing for Daily Forex for about a decade now, and been one of their senior analysts for about 18 months or so. Now, I trade multiple asset classes. I would say I'm primarily a Forex trader, and within that, it's always the majors. I don't really go into cross pair. So usual suspects: Euro USD, Pound Dollar, Dollar Swiss, Aussie Dollar, and so on. I trade some futures contracts, the E-mini S&P 500. I've traded some natural gas futures, and crude oil futures, and occasionally individual stocks. So that's who I am as a trader. But I think really the most important thing I can tell you is that I use technical analysis for my decision-making process. Now, that term means different things to different people. So I'll just define what that means for me. It means that I use the price chart primarily. I happen to use almost no indicators. I occasionally throw on two fib levels, the 50% level, strictly speaking, that's not a fib level, and the 61.8% level, but I don't use many indicators outside of that. So I don't use things like moving averages, stochastics, RSIs, etc. I look at the chart. I find my own support and resistance levels, try to determine where the trend is, and so on. But the core tenet of technical analysis is that it does not take into account fundamental data. So economic data such as interest rate announcements, company earnings announcements, and so on. I will look at an economic calendar to see when the announcements are coming and what high impact announcements might drive some volume, activity trends, and so on in the markets. But I don't say look at an interest rate announcement and try to determine the health of a currency or a company based on that fundamental information. I essentially use a price chart. I'm based in Toronto, Canada. If you are in my neighborhood, in my province in Ontario or nearby, give me a shout. Feel free just to email me. I'm always happy to meet new traders. Okay, so three things that we should know about cryptocurrencies. So the first thing, I'm going to summarize. We're going to look at the first thing, and the first thing is how to execute cryptocurrencies. Now, if you're trading Forex, there's a lot of standardization now between Forex traders, between Forex brokers. You can trade Forex, you can trade the CFD versions, the lot sizes, etc. Are pretty standard across brokers. Now, with cryptocurrencies being a newer market, being an evolving market, there's a lot of different ways of trading cryptocurrencies. They have the different methods have different pros and cons. So we're going to go through some of those methods of actually executing the trade. You don't really have to think about it with stocks and Forex, as I said, but with cryptocurrencies is much more of a factor. Okay, so let's look at the different ways. So the first and most obvious way is to just trade the underlying asset. So you buy the actual coins. Now, to do that, you have to go through the best way, the safest way, really, is to go through an exchange. The exchanges like Coinbase or Binance, and there's some pros and cons with doing that. Now, the big pro is that you actually own the asset, you own the coins. It's a nice way of just getting into the market, getting your feet wet. Okay, I own the coins. Let's see how the value changes over time. It's a bit like owning a share of a company, owning the equity itself. Now, the cons with that, the negative aspect, is that it is difficult to short when you are trading the underlying assets. The way it's set up at the moment with Coinbase and Binance, some exchanges do allow some shorting, but it's not direct shorting. It's they have a second instrument that's set up to short, but it's not easy to go short. So it's really, if you're going to own the underlying asset, it's really much more of a buy and hold play. You think it's going to go up in the long term, and you should take a long position. There's little leverage that's available when you're buying the actual coins. Now, some jurisdictions, some states in the US, for example, allow for some leverage, about 1 to 2 leverage, but you have to be a customer within that jurisdiction. But for most traders, you can't get any leverage when you're trading the underlying asset. Now, that's trading the underlying assets. The other way you can trade cryptocurrencies, and I'm quite a fan of this way actually, is to trade the futures. So I mentioned earlier that, I trade S&P 500 mini S&P 500 futures, natural gas futures, crude oil futures, etc. You can trade now the larger exchanges. For example, the Chicago Mercantile Exchange has a futures contract on Bitcoin, for example. Okay. Now, what are the advantages of trading futures rather than trading the underlying asset? Well, firstly, you can do long and short trades. Any futures contracts, you can go long or you can go short. So you can take both sides of the market. There will be times, as I'm sure anyone knows that I've been monitoring cryptocurrency prices, there are times when the price of cryptocurrencies is rising. You can sit on the sidelines if you want while the price is falling. But if you're a trader, you typically want to take both, at some point, take both sides of the market, maybe short an asset. So you can go short a cryptocurrency with a futures contract. There's tons of leverage with futures contracts, depending on, it can be up to 1 to 200, depending on the futures contract you're looking at. But especially with the price of some of these coins, leverage is fantastic. Having access to leverage is great. And trading the futures means there's a central exchange. So in this case, for Bitcoin futures, you've got the Chicago Mercantile Exchange, the CME. There's loads of advantages. You get a lot of price transparency, volume transparency. When you've got a futures brokerage, you're looking at the price and the volume data from the exchange. It's the exchange that's responsible for settling that, for routing that trade, for delivering that, for executing that trade. And there's a ton of regulation behind it for both the exchange and the broker. So having a central exchange, it does give you that framework for your trading. The cons are that you require a futures broker. Not all futures brokers take clients from any part of the world. There are lots of regulations to opening a futures account or futures brokerage account. Many of them have very high account minimums as well. So if you've got a very small account in the hundreds of dollars, perhaps, you might not be able to have the margin or the account minimum size to open a futures account. Okay, the next way is using a Forex broker or a CFD broker. So what are the advantages with that? Just like futures, you get long and short trades, you get plenty of leverage, and you can have smaller account sizes with a Forex for the Forex brokerage or a CFD brokerage on average compared to a futures brokerage. And you can use platforms. First of all, you can pick your broker where it's regulated. So if you want a Canadian regulated broker or a US regulated broker or a European regulated broker, depending on where you are, you can find a brokerage that's regulated in your region, UK, Australia, and so on. So you can pick a broker that's regulated in the jurisdiction that you're in, or a regulatory jurisdiction that you trust. And lastly, you can have the same platforms that you use for your Forex trading. So if you are very familiar for things like MetaTrader 4, MT4, MetaTrader 5, you can use the same platforms to trade Bitcoin or trade your cryptocurrencies. So what you're seeing there on the screen right now is a real summary of the different ways. The main way, this isn't an exhaustive list, but it's the main ways you can trade cryptocurrencies. You can trade the underlying assets through an exchange. You can trade the futures, or you can use a Forex CFD broker. Now, they all have their advantages and disadvantages. You need to look at things like whether you just want to go long, or do you want to do long and short? How much leverage do you want? Regulation, and so on. Your account size, etc. For me, I think, like for like, on the whole, using a Forex or a CFD broker is probably the most advantageous way. Next would be trading the futures, and lastly would be using something like Coinbase or Binance. Okay, So that's the first thing you should know. The second thing you should know is, okay, well, which cryptocurrencies should you trade? There's a bunch of them out there, dozens now probably. But what are the main ones? Which should you look at? Which should you stay away from? So what are the top 10 cryptocurrencies? So when I say the top 10 cryptocurrencies, I'm going to measure them by market capitalization, or the amount of float of crypto there is out there. So I'm not going to be looking at it from volatility or trends or anything like that at the moment. So when I say the top 10 cryptocurrencies, what are the biggest cryptocurrencies? So the biggest one, this is going to be no surprise to anybody watching this, is going to be Bitcoin. So I pulled these numbers yesterday in terms of market capitalization from coinmarketcap.com yesterday, October the 11th. So these are the numbers. I've rounded it up to the nearest billion. So Bitcoin at the moment is just over $1 trillion, basically 1.074 trillion, or $1,074 billion worth of market cap. Now, I consider that to be the daddy of cryptocurrencies. It was the first, it's the largest at the moment. And the next largest is Ethereum. Ethereum is at the moment less than half the market cap of Bitcoin, about $412 billion. It's still very substantial, though. It's not a small play. It's a very decent sized cryptocurrency. So those are the top two. Then you've got a big step down to the next 7 or 8, and I'll bring them up together. You got Cardano at $70 billion. You got Tether and Binance. I'm going to come back to that in a second. And you got XRP or Ripple, 50 billion, Solana at 40 billion, 43 billion, Polkadot, 33 billion. Elon Musk's favorite coin of choice at one point was Dogecoin at $30 billion. But you can see how much smaller they are than Ethereum and then Bitcoin. They don't hold a candle to it. Now, when you look at Tether, Binance, and USD coins, they are, I've highlighted those in light blue. They are what's known as stable coins. So Tether, for example, is pegged to the value is pegged at $1, and it's used as a coin to get in and out of other coins. So very often you'll see Bitcoin quoted against Tether as opposed to US dollar. It's used just as a mechanism to buy and sell other Bitcoins. It's known as a stable coin. Binance coin is similar. It's used by the Binance exchange to transact their clients' cryptocurrency orders. USD coin, same thing. So they're not really speculative instruments, those three, but they do have a market cap. So I put them up there. I put them up there in the top 10. If you're looking for more information on some of these cryptocurrencies, who founded them, when they were founded, some of the technology behind it, even for researching this webinar, I found one of the best sources has been Wikipedia of all things. So I've just gone to the Wikipedia page for the various cryptocurrencies. What does it mean to have high market volume? So why trade Bitcoin versus Dogecoin, for example? What are the advantages of having high market capitalization, high volume traded? Well, the first advantage is that higher market cap assets, whether it's cryptocurrencies or something else, shares, Forex pairs, higher market capitalization, higher volume, higher activity, order flow, etc. It lowers the trading costs and in particular spreads. That's the first advantage. The second advantage is with higher market capitalization assets, you get to do better technical analysis. That's super important. If you're going to, assuming that you're going to use, I say this with tons of bias. I'm a TA trader, I'm a technical analyst. But higher market cap, technical analysis relies on market psychology and crowd psychology. The more of a crowd you have, individuals can be more unpredictable. I might have different meals, different times of eating during the day, different times I might watch TV and so on. But if you took about 200 of us or 1,000 of us, you could start averaging those times that we have meals, averaging those times we watch TV, and those averages don't tend to change as much. Technical analysis relies that crowds can be much more predictable, stable compared to individuals. And the higher the crowd, the better technical analysis you can do. Higher market cap, higher volume, you have fewer gaps in the price. Gaps can cause a terrible slippage. You can get positive slippage as well. But you can get, when let's say you got a stop loss or you want to get out of the trade at a certain price, it gaps against you. you end up taking a bigger loss, so you don't capture as much of your profits because of negative slippage. So higher market capitalization. However, you just look at a small stock out there, a small company maybe worth $50, $100 million. Look at the price chart. You'll see tons more gaps in the price than, say, something like Apple or General Electric or Facebook or Google. And there's top 10 S&P 500 stocks. Okay, so that's why high market cap and volume on the whole are better. That's not to say you shouldn't trade Dogecoin. If you see an opportunity, if you know something, or if you feel you've done some fundamental research, I'm talking from a lens of technical analysis. If you've done some fundamental research and you think, no, that this particular coin or asset class is going to pop and I want to get into that play, by all means, go ahead. Talk a little bit about spreads, just how to think about spreads. And really knowing the cost of your trading. Spread is going to be one of the biggest costs of your trading, then commissions. So really, you want to consider spreads not in isolation, but as a portion of the average daily move. So we'll use Euro USD first as an example, something we're all familiar with, and then we'll look at Bitcoin next. So let's say your average daily move is 60 pips. You can measure your average daily move of whatever period you want to consider. I think MetaTrader 4, the average true range, average daily range indicator is set to 14 periods. So if you're looking at, you can change that on the indicator setting, but if you're looking at, let's say, the daily chart, you're looking at the last 14 days, for example. So let's say the average daily move is 60 pips. The spread is 1 pip. Well, the spread as a percent of the daily move is 1.7%. So you're paying 1.7% in spread of the average daily move. Compare that to something like Bitcoin. Let's say the average daily move is $3,000 and the spread is $75 for your platform. Well, then it's about 2.5%. So it's not too bad. It's not as good as Euro USD, probably around some of the maybe dollar yen, maybe some of the crosses like Euro yen, but it's in the same ballpark. So when you're looking at spread, you need to look at it compared to the average daily move and use that as a portion or as a percentage to see if you're getting value. You start getting 5, 7, 10% spreads of the average daily move. It takes a lot longer to make up the spread. It's a higher cost to trade that particular asset class or that cryptocurrency. If you want to find out the average daily move, or what's known as the average true range on the MetaTrader platform, pull up your platform, go to Insert Indicator, Average True Range. You'll see the indicator pop at the bottom, and you can see that average true range. And you can play around with the time frame or the number of bars it uses to calculate the average true range. If you want to look at the average daily true range, make sure you set your chart on the daily platform, so not like the hourly or the 4 hourly, whatever. It should be on the daily chart, and then you'll get the average daily true range. Okay, next, what are some of the key levels and trends in cryptocurrencies? Now, you want to make sure, of course, that you find, let's say you've decided to use a Forex broker, or you're trading the futures, you're trading something like Bitcoin, nice high market cap. You still have to get into the right trade. You have to get in the right side of the market, whether it's going up or down, and at a level that makes sense, that allows you to place a stop loss and a nice juicy profit target that's higher than your stop loss. You still have to trade intelligently. Numbers 1 and 2, you can learn once and then just rinse and repeat. Number 3, the key levels of trend and identifying key levels and trends. This is where you will differentiate yourself as a trader. This is the difference between profit and loss. And this is the skill set that you're constantly refining months after months, year after year. Okay, so I'm going to look at the key levels and trends on the top 2 cryptocurrencies by market capitalization, Bitcoin and Ethereum, and we're going to start off with Bitcoin. So Bitcoin, the symbol is BTC, and this is the Coinbase platform. I pulled this from tradingview.com. This is the Coinbase chart of Bitcoin. Now, this is the daily chart. So we're going back to, it's about over a year's worth of data, going back to August 2020. Now you can see there's a big run up from the beginning of the chart. And I'm going to divide this chart into three main areas or 3 main sections. So first of all, you saw this big run up of the value of Bitcoin. I think it kind of kicked off early last year, but in September, it really started to jump up. Popped out of this range and over that September to March, what is that, 8-9 months? Yep, 8-9 months. I'm calculating in my head. You saw this big run up in price from like $7,500 to like $55,000, and it was close to 60,000. It was just over $60,000, I believe, at its peak. So we're talking more than almost like a tenfold rise in value in a few short months. It's the absolute value in rise is not phenomenal. The value in the time it took to make that uptrend, that run up, was also great. It was also very, very quick. It's a short time. You can see as it started rising, it started getting more volatile. Remember, this is an arithmetical chart. She's showing the price scale on the right in a linear format. If you wanted to figure out how much more volatile it is, do look at it in a log chart where it shows the scale is actually in percentage. So you can see, obviously, this is going to be more up and down here because the price levels are higher compared to here. But in terms of percentages, it might be roughly the same down here. But that was the first part. You had this big run up. Elon Musk started tweeting about this. You got this big long bar right there. I think that's when Elon Musk first started tweeting that he wants to take Tesla, I believe, said we'll take Bitcoin as payment. But that was really, towards the end of the move. And then it started to get pretty volatile, and you got a reversal pattern. Now, some people might see a head and shoulders. Some people might see a rounded top, but essentially the price stalled and it reversed. It made 3 tops with a central top higher than the two either side. So you had a higher high, then the lower high, then the price kind of collapsed, and it collapsed quicker than it ran up. Actually, it collapsed pretty hard, and over maybe 10 or 12 trading days, it halved in value. When people talk about the risk of cryptocurrencies, they're talking about this level of volatility. In the last half of, and the first half of 2020, 2021, that 6-9 month period, a lot of crypto millionaires were made. But a lot of people didn't appreciate the volatility that came with it, and were caught out in this really messy range from March to June of 2021. Sure, people made money there. I'm sure people lost a lot of money. And when it collapsed hard. You look at the end of May or you look at that period in May, you've only got about a dozen trading candles. You've got 2 weeks of trading candles maybe, where the price just halved. And if you leverage in any way, of course, that can wipe out a good chunk of your savings. And it has recovered. It found support over June, July, August, made a base around $27,500 per coin. Found a nice strong base, hit it 3 times, really cemented that. And from then in August, it launched a nice impulsive move up and started a new uptrend. It's not been the cleanest uptrend, but it has been, it's held its ground. Let's look at this. Let's look at some of the levels that we should be paying attention to now. So I'll keep the support highlighted there. I think that could still come into play. If the price collapse, I think that could still be a buy area. I think that support will hold, but there's a good chance. My hunch is that it's not going to see that price again. I think it will continue to new highs. Now, the first level I want to identify is around the $42,000 mark. I put that line $41,986. The first chevron, the first arrow on the left, that it's the high of that line. That's where I marked that line. So that was the first big pullback in the uptrend. Got really messy. There's some proper selling orders that came in there, but then buyers held their own, and the market took off. And then you can see the big breach through, and it's been tested as a resistance and as a support. Not cleanly. It's wavered around that level, which certainly is a key level. So that's the first key level. I think if the price comes back down to that level, I think it might test it as a support again. But my hunch is now, because of that support, a strong support at $27,500, big impulsive move afterwards, the previous resistance broken, tested again as a support, and again a nice big impulsive move after that. I think Bitcoin is now in for another to make new highs. Now it's in that reversal area. It could get pretty messy before it goes on to make new highs. It could wave around sideways. But I think the next level to watch is going to be $65,000 roughly, 64 and a half, $64,899. I've marked as the top of the all-time high. My hunch is that it's going to break that and settle on the other side as support. That's where I think the next big trading opportunity is going to be for Bitcoin. I think wait till it breaks that new high, old last time high, new high, comes back down on the low. Have a look at maybe the 15-minute, 4-hour time frames. You get some trades in really nice small stops, but you could hang on to those trades for months on end, as there's no previous resistances to stop. I think it's made some nice supports along the way. It's shaken off that reversal area in the early part of 2021. And I think it's the chart setup certainly is telling me that Bitcoin is stabilizing in value and it's looking at buyers are in control. People are interested in it. So that's Bitcoin. Okay. Ethereum. We'll do the same analysis for Ethereum. Daily chart going back to around the same level, August last year. This is a little messier. It's had a similar pattern to Bitcoin. Now, it's half the market cap, and you can really tell by the shape of this chart, it's not as well traded, even though it's still got market cap right now, $400 billion. So you've got the big run up right to the peak, no messing around there from about September last year. There was going to be a ton of correlation. I don't think you'll see Bitcoin and Ethereum diverge in value. You'll see them make different highs at different points in time. One's going to be messier than the other, but I don't think you'll see Bitcoin shoot to the moon and Ethereum die. I think there's going to be correlation. So some people may choose Ethereum as a play on Bitcoin. They'll watch Bitcoin go up and they think the next one will be Ethereum, and they'll go into Ethereum next to catch that rise. So that was a run up to mid-May last year. Big collapse, and the collapse was swift again. There was no real turning point. If you look at if you were to go back and look at Bitcoin, when it reversed, it spent a month or 2 months reversing, going to that sideways range. That's what happens with higher market capitalization assets. It takes time to turn around those buyers and sellers. Here, it spiked up and then as quickly spiked down, 10 trading days, maybe 2 weeks, boom, from $4,400 to about $1,200, $1,600. So it lost about 2/3 of its value in 2 weeks. Again, maybe there's some short plays in there. People who saw that made a ton of money going short, but I'm sure a lot of people lost on the long plays. Found support around the $1,600 mark, and then it's had a nice rise, really big impulsive move, but it's also gotten messy now. So just looking at that, what are the levels? The next level for it to break is $4,025. That I would say minor resistance, that resistance there, and the all-time high of 43.81. I think Ethereum will go up because Bitcoin is going up, and I think it will be I think they'll be correlated. They're the two biggest coins out there. Ethereum is just a lot messier. I would consider a play at 43.81. If it broke it, settle as a support, break that as a resistance, settle around as a support, looking at the lower timeframes, then I think it's got some room to run. But the Bitcoin chart is by far the cleaner chart at the moment. Not 100% clean, but I think it's got a clearer technical picture. But Ethereum has a ton of potential as well. So that's my analysis on Ethereum. What are some of the resources out there on cryptocurrencies? Invest Markets, pretty decent. It's one of our partner brokers. Some really great write-up on how cryptocurrencies started and some of the different features of different cryptos. You can trade cryptos through CFDs on Invest Markets. So just go to investmarkets.com, go to CFD, and then go to cryptocurrencies, and you'll get all the information right there. And then FX Academy has got a cryptocurrency course, fxacademy.com. Just go to Learn to Trade, go to cryptocurrency. I think it's the 7th or 8th menu option down there. And in the summary email you'll get for this webinar, those links will be on there. Some final thoughts. Mind your risk always. Always, I think you should always trade with a stop loss and have targets which are higher than the stop loss. Whether you get out of half the trade or get out of all of it, you typically don't want to take targets which are smaller than the value of your stop loss. And if you want to reach out to me anytime, Huzefa at dailyforex.com. Be happy to hear from any of you watching as a recording or live. Have a fantastic Tuesday. If you're watching on Tuesday, have a fantastic week. Thank you very much, everyone.